Picture this. Two friends graduate from college in the same year. Sarah diligently saves $500 every month in her savings account, earning a modest 1% annual interest. Her friend Marcus takes that same $500 and invests it in stocks, real estate, and business ventures. Fast forward 20 years. Sarah's savings have grown steadily, but inflation has eaten away at her purchasing power. Meanwhile, Marcus has built a portfolio worth millions. Sarah did everything she was taught to do. She played it safe. She was responsible. So why is she falling behind while Marcus, the risk-taker, is thriving? The answer lies in a financial system that was never designed to reward savers. Welcome to Financial Stories of Wealth, where money, history, and power come together. Today, we're diving into one of the most controversial truths about modern finance. Our entire economic system is engineered to reward those who take risks while quietly punishing those who save. It's a system where borrowers prosper and savers lose ground year after year. Sound unfair? Perhaps. But understanding why this happens might be the most important financial lesson you'll ever learn. Because once you see how the game is really played, you can't unsee it. And more importantly, you can start playing to win. Let's start with the elephant in the room. Inflation, this silent wealth destroyer, is the primary weapon used against savers. According to recent research analyzing purchasing power, inflation reduces the real value of money sitting in bank accounts without ever changing the balance you see. When inflation hits 3% annually, that $10,000 in your savings account loses nearly $1,400 in purchasing power over just 5 years. After 10 years, it effectively shrinks to $7,441 in real buying power. After 20 years, nearly half its value disappears, even though your bank statement still shows $10,000. Here's the cruel irony. Most traditional savings accounts pay interest rates well below inflation. Major banks currently offer as little as 0.01% interest, while inflation runs much higher, creating a gap that widens each year. The St. Louis Federal Reserve found that during high inflation periods, the purchasing power demand deposits, time deposits, and savings deposits was reduced by nearly $1.8 trillion in just 12 months. That's not money lost to bad investments or risky behavior. That's wealth quietly transferred away from responsible savers. Now contrast this with risk takers. When inflation rises to 3% and you're earning 8% returns on investments, you're gaining real purchasing power. The financial system rewards this behavior through multiple channels. Stock markets historically outperform inflation over the long term. Real estate appreciates while mortgage debt gets cheaper in real terms. Business owners can raise prices with inflation, protecting their profit margins. Risk takers don't just keep pace with inflation, they leverage it. But it gets deeper than inflation. Central banks around the world conduct monetary policy that inherently favors borrowers over savers. When the Federal Reserve lowers interest rates during economic downturns, borrowing becomes cheaper, encouraging spending and investment. This expansionary monetary policy reduces the returns savers receive on their deposits, while making it easier for risk takers to access cheap capital for investments. As noted by several European central bank analyses, these low interest rate environments create conditions where those willing to take on debt for productive investments benefit significantly more than those holding cash. During the 2008 financial crisis, this dynamic became impossible to ignore. Central banks cut rates to near zero, and in some cases, even below zero. Several countries, including Denmark, Japan, Sweden, and Switzerland, experimented with negative interest rates, essentially charging banks to hold excess reserves. The goal was to force money out of safe holdings and into the economy through lending and investment. Savers suffered from minimal returns, while borrowers enjoyed historically cheap credit. And when the system collapsed, the risk takers who brought down the global economy were bailed out with taxpayer money. The Emergency Economic Stabilization Act of 2008 authorized $700 billion to bail out failing banks through the Troubled Asset Relief Program. While official government figures later claimed the program was repaid and even profitable, economist Deborah Lucas calculated the true direct cost at approximately $498 billion, or 3.5% of GDP. But even that understates the real cost. Research from the World Bank noted that the implicit guarantee provided to major financial institutions, the expectation that government would rescue them, provided an annual subsidy worth approximately $60 billion during the crisis, peaking at $84 billion in 2008. This implicit insurance transferred massive wealth from taxpayers to large institutional investors and creditors. Think about what this means. Risk takers at major banks made catastrophically bad bets with borrowed money, crashed the global economy, and were then rescued by ordinary taxpayers, many of whom were savers who had played by the rules. Meanwhile, nearly 10 million Americans lost their homes to foreclosure. The moral hazard is staggering. The system socialized the losses while privatizing the gains. This brings us to perhaps the most famous critic of saving, Robert Kiyosaki, author of Rich Dad, Poor Dad. One of his most controversial lessons states directly, savers are losers. Kiyosaki argues that traditional advice to save money and avoid risk keeps people trapped in the middle class. His philosophy emphasizes that the wealthy don't work for money. They make money work for them through investments, businesses, and assets that generate cash flow. In his view, those who hoard cash in savings accounts are losing the wealth-building race before it even begins. Is Kiyosaki being provocative? Absolutely. Is he wrong? The data suggests otherwise. Risk-takers operating in bullish markets historically earn significantly higher returns than conservative savers. Research shows that individuals with higher risk acceptance are substantially more likely to own stocks, bonds, and mutual funds. And the indication of risk acceptance is 10 times more powerful in explaining asset ownership than objective factors like market returns. This suggests that cultural and psychological factors around risk-taking may be more important than economic fundamentals in building wealth. But here's where it gets interesting. The relationship between risk and reward isn't always logical. A study by ING analyzing 15,000 people across 15 countries found something counterintuitive. Many people, particularly in Germany, Austria, and Poland, believe that riskier investments will produce lower returns, completely backwards from how markets actually work. This misunderstanding of risk keeps millions of people in low-return savings vehicles even when they have capacity to invest more aggressively. The financial system compounds this advantage for risk-takers through what economists call the credit channel of monetary policy. When central banks ease policy, broader credit conditions improve, making it easier for entrepreneurs and investors to access capital. Banks become more willing to lend. Business investment increases. Asset prices rise. Those positioned to borrow and invest during these periods accumulate wealth rapidly. Meanwhile, savers watching from the sidelines see their purchasing power erode. Consider the tax system as well. In many countries, capital gains from investments are taxed at lower rates than ordinary income from wages. Interest earned on savings? That's typically taxed as ordinary income at the highest marginal rate. The system literally taxes savers more heavily than investors. Borrowed money for business or investment purposes. That interest is often tax-deductible. The entire structure incentivizes debt-fueled investment over patient saving. Now, before you think this is an argument against ever saving money, let's be clear. Emergency funds are essential. Having cash reserved for unexpected expenses is fundamental financial planning. But keeping large amounts of wealth in traditional savings vehicles for extended periods is a losing strategy in inflationary environments. The question isn't whether to save, it's what to do with those savings once you've built a safety cushion. The uncomfortable truth is that our financial system was designed this way intentionally. Economic growth requires investment, entrepreneurship, and risk-taking. Money sitting idle in savings accounts doesn't build factories, create jobs, or drive innovation. From a macroeconomic perspective, the system needs to incentivize risk-taking to function. The problem is that individual savers bear the cost of this systemic design without fully understanding the game being played. This is why financial education matters so desperately. Most people are never taught that inflation is systematically eroding their savings. They're never told that central bank policies favor borrowers over lenders. They don't understand that the safe choice of keeping money in savings accounts is actually the riskiest long-term strategy for wealth preservation. They follow conventional wisdom, get a job, save money, avoid debt, while watching the wealth gap widen. The system rewards calculated risk takers who understand how money, credit, inflation, and investments interact. It rewards those who borrow at low interest rates to invest in appreciating assets. It rewards business owners who can pass inflation costs to customers. It rewards investors who position their portfolios to benefit from monetary policy and economic cycles. And increasingly, it rewards those who understand that the greatest risk isn't losing money on an investment. It's losing purchasing power by not investing at all. So what does this mean for you? First, recognize that inflation is not neutral. It's a hidden tax on savers and a subsidy to borrowers. Second, understand that central bank policies create winners and losers, and you need to position yourself accordingly. Third, develop the financial education to distinguish between productive risk-taking and reckless gambling. And finally, accept that building wealth in the modern financial system requires embracing intelligent risk rather than avoiding all risk. Symbolic realism oil paintings showing the financial system as a massive pinball machine, or Rube Goldberg device, where the mechanisms are visible but complex. Those who understand the machine reading instruction manuals, studying the mechanisms, can position themselves where the ball/wealth flows. Those who don't understand stand in wrong positions, confused why they're not succeeding. The rigging is the intentional design favoring risk-takers over savers, not corruption, but structural incentives clearly visible to those who look. Classic editorial art style, painterly texture, muted machine metals and mechanical complexity, with success path goals, cinematic lighting highlighting the visible but misunderstood mechanisms, symmetrical composition centered on the complex but understandable system, intellectual and clarifying atmosphere, high detail on the system's rules being visible yet widely misunderstood, and the advantage go to those who study rather than assume. Now I want to hear from you. Do you agree with this assessment of how our financial systems reward risk-takers over savers? Or do you think there's still value in the traditional approach of conservative saving? Have you experienced this dynamic in your own financial life? Share your thoughts in the comments below. I read every single one, and your perspective might help others seeing this for the first time. If this video opened your eyes to how the financial system really works, please like this video and subscribe to Financial Stories of Wealth. We're building a community of people who want to understand the real rules of money, power, and wealth, not the fairy tales we were told growing up. Hit that notification bell so you don't miss our next deep dive into the financial truths that shape our world.